So guys, today we're looking at my entire dividend stock portfolio, and honestly, in the last year, just taking inventory of everything, this portfolio has come such a long way. I've added some positions, I've sold out of some positions, and overall we're in a great spot right now. We are coming up on $100,000, and I am so excited to show you all of the different holdings across my two different accounts, my taxable brokerage account and my Roth IRA. Now guys, in addition to the portfolio, this YouTube channel has also grown a lot in the last year. And in case you're new to the channel, welcome aboard. My name is Ryne, and this channel is completely dedicated to the awesomeness of dividend stock investing. I've been an enthusiast and a practitioner of the craft myself for the last 4 to 5 years, somewhere in there, and I believe this is hands down the easiest way to create passive income, and I think this is something that anyone can do. My goal with all of this investing stuff is to someday use my dividend income to cover all of my expenses and pay all of my bills, and I've got to say, I feel like I've really come a long way just in the few short years I've been doing this. When I started making videos here on the channel back in October of 2020, which I can't believe that it was that long ago now, that's crazy. But at that point in time, I only had about $15,000 invested. But now, if we take a look at my portfolio, that number has now more than 6x and is sitting at almost $93,000. And by the way, guys, what we were just looking at was from Snowball Analytics, which is actually the sponsor of today's video. This is a really cool portfolio tracker that I think you guys would like a lot, and I want to tell you a little bit more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. I've been using this platform pretty religiously to track my own portfolio for a while now, and I'm extremely impressed by just how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and I found the platform pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much insight it offers, not only into your portfolio, but also at the individual stock level as well. I mean, pretty much anything you want to know about a company's financials or dividend history can be found here within Snowball Analytics. Now, in my opinion, what really sets Snowball Analytics apart are the features that it has designed specifically for dividend investors. I'm actually convinced this platform was made for us, and here are a few of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show share price returns, which is only half of the equation, so it's refreshing to see dividends factored into these calculations. Additionally, Snowball also has a pretty robust event calendar that keeps you updated with upcoming news, events, and dividend payments, and they even have a dedicated dividend calendar so you can see who's paying you each month, when they're paying, and how much they're paying. And then another favorite feature of mine is Snowball's backtest tool, which lets you see how your portfolio stacks up against the S&P or any other benchmark across multiple time periods. And once again, dividends are included in the calculations, which is awesome. And beyond these tools, Snowball also offers a community feature where you can check out other users' public portfolios to see what others are investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and what's popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a free 14-day trial. And if you like it, you can save 10% on your subscription when you use the code Ryne Williams. I've personally really enjoyed using Snowball Analytics, and I know you will too, so definitely check out that 14-day trial. And don't forget to use code Ryne Williams to save 10% on your subscription. But anyway, guys, getting back to it, as I'm sure you can imagine, in addition to my portfolio value seeing some really nice growth, my dividend income has done the same over these last few years. Looking at the breakdown of my annual dividend income over the years, my first year of investing in 2020, I only brought in about $108.23, which actually for my first year of investing is not too bad, especially considering this wasn't even a full year. When I did have my first full year of investing under my belt, which was 2021, we really saw a jump in this annual income going from about $110 in 2020 to almost $1,000 just 1 year later. This is a pretty substantial jump. And even from 2021 to 2022, the dividend income almost doubled, going from, about 900 to almost 1,800 right here. So this is a really big jump. And this was also the first year I brought in over $1,000 of dividend income. That was a really cool milestone. And furthermore, this next year, 2023, was another nice increase. We added about $500 or so to the annual dividend income. And we also hit another milestone. 2023 was the first year I brought in over $2,000 of annual income, and I was almost at $2,400 for the year, which would have broken down to $200 on average every single month. Now, it was only a year later that we officially hit that milestone. In 2024, this last year, we brought in $2,820 of dividend income, almost $3K, and at this point was averaging somewhere around $250 of dividends per month, which is crazy. And jumping back over to Snowball, at this point in time, guys, my projected annual income moving forward is $3,144.82, which breaks down to about $262 on average every single month, or $8.62 in dividends every single day without having to lift a finger, which means that if I wanted to just from dividends, I can get myself a double-double and some fries from In-N-Out Burger every single day for the rest of my life. That is so cool. And hopefully by this time next year, guys, we'll be at Chipotle burrito status. That would be awesome. We're not quite there yet, maybe about $1 away, but rest assured we will get there. Now, like I said earlier, I have two different accounts. I have my main taxable brokerage account, which is all that green there, currently makes up about 82.7% of my total portfolio, while my Roth IRA makes up the other 17.3%. Up until about a year or so ago, I was investing a lot more heavily into my taxable brokerage account, but at the start of last year, I ended up switching things around and started maxing out my Roth IRA, taking a little step back from the taxable account, and now at this point in time, I've got to a point where I'm investing about an equal amount into both every single week. The Roth IRA is great for that long-term tax-free growth and income, but I won't be able to access the investments in that account without penalty until I'm 59 and a half, which is almost another 30 years from now. But meanwhile, my taxable account gives me the option to tap into my investments before then if I ever want to, which I think that I will. And obviously, everyone's situation is different, but like I said, I think this gives me the best of both worlds, and it ensures that I'm thinking about my retirement in the future while also still being able to maintain some financial flexibility along the way. That's important to me. Anyway, guys, now that we have seen the big picture and have a good sense of where the overall portfolio is at, now let's dive under the hood into each individual account, starting here with my main taxable brokerage account, which, as we established, makes up the bulk of the overall portfolio. And at this point in time, it's currently valued at just under $77,000. I actually think this is an all-time high for this account as I'm looking at it, which is very cool. And we're seeing some pretty good profit in this account. Overall, including dividends, I'm up about 45%, which equates to almost a $24,000 profit. Not too shabby, if I do say so myself. And if we look at the breakdown of the dividend stats over here, this account currently has about a 3.5% yield, which I think is pretty respectable, and a 6.3% average dividend growth rate across the account. So I think these combined stats are pretty solid, and every single year this account is generating $2,700 of dividend income. And now that we know kind of the high-level stats of this taxable account, I want to go even deeper under the hood and show you each individual holding. And at the top here, we're going to start with my smallest weighted position and then work our way up from there. And as we can see, the smallest position in this account is Blue Owl Capital Corporation, of which I have 116.4 shares. It makes up about 2.3% of the portfolio, and this is my portfolio's highest yielder at about 11%. And so far, I'm doing pretty good with Blue Owl. I'm up about 35%, including dividends. And then moving on, my second smallest position here is going to be AbbVie, of which I have 10 shares, and my only regret with this stock is that I don't own more of it, because I've done really well with AbbVie. I'm up 82%, including dividends, and it makes up 2.5% of my total portfolio. But anyway, guys, now moving on to position number 3. This one is WP Carey, of which I have 38 shares, and this one has been such a laggard in my portfolio. In terms of share price, I'm down 10.7%. I am in the green, including dividends, just barely though, and WP Carey makes up just under 3% of the total account. And then moving on to stock number 4, this one is Clear Secure. This is the newest position in my portfolio, and it's quickly become my biggest loser, as we can see right here. I'm down almost 20% with Clear, but once again, this is a relatively small position for me. It's only 3.2% of the account. But anyway, now moving on to position number 5. This one is Kilroy Realty Corporation, KRC. I have 77 shares, and I'm down just a little bit in terms of share price. I'm down 6.7%. This one's been kind of a laggard for me as well. This one and WP Carey have been pretty underwhelming, but thank goodness for those dividends, because that's bringing me back in the green. I'm up 5% on a total return basis, and KRC makes up 3.5% of the total portfolio. And now moving on to stock number 6. This one is Altria Group. I have 56 shares at an average cost of $42.63, which is pretty good. I think this is a pretty good average cost. The current share price is about $10 above that right now, and that's going to leave me up 46.3%, including dividends, about 25% just in terms of share price. But either way, this is looking good, and Altria makes up 3.9% of the total account. But then, guys, now we've got Snap-on. I love me some Snap-on. I wish I had more of this stock. I only have about 9 shares, and my average cost is pretty sweet, just above $211 per share, and the current share price is over $125 above that right now, which is going to leave me up almost 70%, including dividends. So I've done pretty well with Snap-on. Like I said, I wish I owned more of it, and the stock makes up about 4% of the total portfolio. And moving on, Chevron here makes up exactly 4% of the total portfolio. I'm up 39% with this position, which is pretty good, and I have about 20 shares. I think Chevron's about a middle of the road position for me, and that's kind of where we're getting here in the 4% range. But anyway, moving on to the next stock in the portfolio, this one is Main Street Capital Corporation, which has absolutely crushed it for me, guys. I have 56.25 shares at an average cost of about $40.60. And as we can see, I've done really well both in terms of share price and total return. So including dividends, I'm up 67.3% with Main Street. I don't know what more I could ask for with this position. It's done really well. It's treated me very well, and it makes up 4.4% of my total portfolio. And then, guys, now moving on to the 10th stock in this account. This one is EPD, Enterprise Products Partners. I have about 113 shares at an average cost of just under $24 per share. So the current share price is almost $10 above my cost basis, which is going to leave me up 38.6% just in terms of share price and 55.4% including dividends. And EPD makes up almost 5% of the total portfolio. Really nice. And then, guys, moving on to position number 11. This one is Vici Properties. Also, I would say a relatively new position in the portfolio. I don't think I've owned it for a full year yet, but out of all of the positions that we've looked at so far, Vici is the only one that I'm actively adding to right now. I've pretty much been picking up Vici, I would say, every week or every other week on average for the last couple of months now. I've been really enjoying picking up more shares of this stock because I love it. But anyway, I have 132 shares of Vici at an average cost of $28.16. So now with the current share price just above $30 per share, this is going to leave me up 9.2%, including dividends. So not too shabby there, and Vici makes up 5.16% of the total account. And this will probably continue to increase as time goes on too, because like I said, I've been actively adding to this position. But anyway, now moving on to one of my favorite dividend growth stocks. This one is Lowe's. I have 16.4 shares of Lowe's at an average cost of $194.50, which is very sweet, guys, especially when you look at the current share price. Sitting just above $250 per share, this is going to leave me up 35.5%, including dividends, and Lowe's makes up 5.4% of the total account here. And then, guys, next up is one of my favorite dividend kings. This one is Procter & Gamble. I have 28 shares of PG at an average cost of $139.20, so I'm doing okay with this position. You know, I'm up 28.4%. I've made over $1,100, including dividends. I'm pretty content with it. And Procter & Gamble is getting to the point where it's becoming one of the larger positions in my portfolio. Currently makes up 6.2% of the total account. And I feel totally fine with that. This is such a stalwart, such a steady sleep well at night company that I'm happy to make it a larger percentage of the portfolio. And now, guys, with all of those behind us, this is going to bring us to the top 5 largest positions in my taxable brokerage account. And in the number 5 spot, we have none other than Realty Income. I have 106.14 shares at an average cost of $53.49. So this is going to leave me up 11.3%, including dividends, and Realty Income makes up over 7.5% of the total weighting in this account. Now, moving on, my 4th largest position is Johnson & Johnson, which, like Vici Properties, I've been adding to pretty regularly. I think in the last couple of months, I've added maybe 6 or 7 shares of J&J to my position, which is going to put me just over 40 shares at an average cost of $157.96. So I'm just barely in the red in terms of share price, but I'm up 4% including dividends on a total return basis. And J&J is kind of a whopper in the account, guys. It makes up almost 8.2% of the total weighting. And then we have the position that I've gotten most lucky with. This one is Williams-Sonoma. I have 36 shares at an average cost split adjusted of $66.54. And as we can see, the current share price is now up above $200 per share, which is going to leave me up over 200% in terms of share price. And according to this, the total return, including dividends, is actually less than the share price return. But I think it's just kind of flipping out because of the split. I think that's messing with the total return. And really, my total return is somewhere closer to this number right here. I think really I'm up about 210% with Williams-Sonoma, but either way, it's also a whopper in the account, guys. It's 9.6% of my total portfolio, and most of that has to do, well, pretty much all of that has to do with just how much the share prices run up. And then, guys, moving on to my second largest position, this one is Visa. Probably no surprise, you guys know I think Visa is like the gold standard of stocks, so I'm happy that it's one of my larger positions, and it was my largest position until my number one position saw a crazy run up. But nonetheless, with Visa, I have 23.74 shares at an average cost of just under $270 per share. And so far, I've done pretty well with Visa. I'm up 32.2%, which I think is really great considering I haven't held this position for all too long at all. Maybe a year, maybe somewhere around that, really not much longer than that if it is. But either way, Visa makes up almost 11% of my total portfolio here. And then with that, guys, my largest position, I'm sure you could have guessed it, this one is Starbucks. I have 78 shares of Starbucks at an average cost of $86.34, and it has just seen a crazy run up lately, and now is sitting at $112 per share, which is going to leave me up 34% on a total return basis. And with that substantial climb, that has made Starbucks my largest position, putting it at 11.4% of the total portfolio. So guys, those were all of the stocks in my taxable account. And as you can see, I've got, a pretty good mix of different kinds of stocks there. I've got your classic dividend growth stocks like the Visas, the Snap-ons, and the Lowe's. I've got some high yielders in there, the Blue Owl Capital Corporations and EPDs. And I have some stalwarts, like Procter & Gamble and Johnson & Johnson, which all come together to form what I think is a really well-balanced collection of companies. Now guys, my Roth IRA is certainly the younger of the two accounts. I only started it at the beginning of 2022, but like the main account, this Roth IRA has made some really great strides. Looking at some of the high-level stats, the Roth is currently valued at just over $16,000, which is pretty good. And so far, we're up 14.1%, including dividends, so we're up almost $2,000 in this account, which is great. And looking at the dividend stats over here, this account has a 2.6% starting yield and a 10.2% dividend growth rate. So as we can see, the dividend stats in this account are quite different than what we saw in the taxable. The taxable had a higher starting yield with a lower 5-year dividend growth rate, whereas this one has the lower starting yield, but a substantially higher dividend growth rate. And that clearly just has to do with the makeup of this account, guys. This one is just two different ETFs. We have VOO and SCHD. I dollar cost average into both of these every single week. And so just with the combination of these, that's how we're getting this lower starting yield, because VOO doesn't have a high starting yield at all. And SCHD starting yield is like the mid to high 3% range right now. So when you combine these two, that's how you end up with this number. And SCHD is a dividend and growth monster, and that's why we're getting this higher dividend growth rate. And as you can tell just from the difference in holdings between these two accounts, totally different strategies. Okay, my taxable account is much more hands-on. Every single position in there is hand-selected, all individual companies, whereas with my Roth IRA, I wanted something completely hands-off, something completely automated, and, kind of like my taxable account, something that would be a good all-weather portfolio. And so that's what I was trying to strike in the Roth IRA here with these two different ETFs, VOO and SCHD. And if we look at the combined holdings of both my accounts together here, my taxable and the Roth, we can see that by and large, SCHD is the largest position, which is really cool. And VOO is also in the top 5. I think it's coming in here, the number 5 spot. And because I'm dollar cost averaging into both of these every single week, it's only a matter of time before VOO jumps up into this number 2 spot and the two ETFs overpower the rest of these positions, which is completely fine by me. I think SCHD is the holy grail of dividend ETFs. And in this next video right over here, I'm telling you more about why that is and why I am so happy to have it as the largest position in my portfolio, and also why I'm happy to dollar cost average into it every single week. So click right over here to check that out, and I'll see you in the next one.